All right, everybody, we are live. It is Friday night, Forex and Chill. Y'all know for almost 2 years, we did these almost every single Friday night. A lot of people learned how to trade. A lot of those people, I've seen them go on now to become six-figure traders or funded traders. Some of them are just now becoming profitable because everybody has their own journey. So tonight, we're here to help those of you who are on your journey to becoming funded traders, to becoming 5-figure traders, to becoming 6-figure traders, because that's what we do at Forex and Chill. We give education, no cost, no holds barred. We don't sit here and say, well, you have to join my team or you have to pay me to find out how I mark up. Forex and Chill has always been a free community where we hung out and we just charted together, learned together. In fact, it started out with a couple of friends who just wanted to learn how to trade. We were in a group that was teaching market structures that we just started jumping on Friday nights because we were dedicating our lives to becoming profitable traders. And so here we are today, 3 years later. You know, Forex and Chill is 3 years old this month because 3 years ago, we started hanging out every Friday night learning how to chart and went from 4 people to 10 people to 15 people. You know, then we ended up getting like 350 people on here, 400 people on these calls. So if you are ready to get this call started, you're ready to learn how to chart, you're ready to learn some market structure, you are ready to learn some smart money concepts, show me some love in the chat. I don't care what you drop, just drop something. Drop something in the chat if you are ready to get this call started tonight and learn how to mark up these charts, okay? There we go. I see some noise. We're making some virtual noise. And Mr. Grant, if you will let people in, I see people still coming in because I'm getting ready to get started charting. And you know, once I start, I don't stop. So I appreciate you if you would just let the guests come in. So let's thank Mr. Grant for being our gracious co-host tonight, as always. He's always been with me here on Forex and Chill, and I truly appreciate him. So before I start, I like to see who I'm working with. So on a scale of 1 to 4, we're going to start. If you don't know how to chart, if you do not know how to chart, you're new to charting, drop me a 1 in the chat. If you are completely new to charting, you don't chart every week, you really don't know market structure, I need a number 1 in the chat. Oh, we got some new blood in the house tonight. I love it. I love it. Because you're going to learn the right way. You know, whenever I got started on this thing, I didn't learn the right way. I wasn't taught the right way. And we know about bad habits. Bad habits are hard to break. You know, maybe you started a class or you started a skill set or a hobby or something, and people were like, forget everything you know. I want you to forget everything you know. Well, I'm not asking you to forget everything you know if you're already successful at trading. But for those of you who are new to trading, all of you dropping the number 1s, we're going to set some solid foundations tonight because a lot of stuff we were taught, it was like people who were learning it and reteaching it, and they really hadn't learned properly. They meant well. I can say that a lot of people in my past, they meant well, but they were teaching me what they had been taught, and they had been taught wrong. So I was learning it wrong. And some of the stuff I was teaching, I won't say it was wrong, but it wasn't as solid as the stuff that I'm learning now because I love to study. I'm addicted to Forex. So all you number 1s, you are in the right place tonight. So a number 2, if you're charting, but you're still not sure of yourself, if you started charting, but you're not sure yet, you still get lost in the market. You know, once you get down past that daily time frame, you don't know where to go from there. You know, you get the monthly, weekly, and daily, and you can see it's an uptrend or it's a downtrend. But once you get down below that, you sort of get stuck. You don't know if you should be looking for a buy or a sell, where you should be looking for your entries. So that's my number 2s. So number 3s, if you're charting consistently and some of your trades are starting to play out, you're starting to at least break even, you're making your way up, you know, it's starting to make sense. It's the number 3s. Where are my number 3s? You're able to start taking your own trades. You're not rich yet, but you know you are on the path to getting there. You're starting to become consistent, and you're starting to see the light at the end of the tunnel. The light at the end of the tunnel, people. Y'all know that it's coming, and you are not giving up. You are not giving up. And that's why you are here tonight. All right, we got a lot of number threes. I love it. I love it. I remember when that number, I'm sitting here grinning now, thinking about when I hit that number 3 level. I'm like, oh my God, this makes sense. Now I just need to work on my entries. So do we have any people, any level 4 people that you're trading consistently? You're able to make withdrawals. You're like me, you love to study and you love to interact with other successful traders. Number 4s, if you're doing this thing and you know that this is what you want to do for the rest of your life, or you're able to make those withdrawals and pay bills. So Rose, between the 3 and the 4, we got some number 4s. I love it. I love hanging out with other traders. You know, it's just like when you go to a ball game and you see all the fans that flock together because they love being with people who love the same things. So that's it. I wanted to see where we stand. So for you number 3s and 4s, be patient with me because I'm going to break it down easy in the beginning. So our number 1s and number 2s won't get lost. But as we go, we're going to get more advanced. And so I just thank you for your patience right now. So I'm going to take the first few minutes and make it sort of easy. So for those new people, if you look at this, you know, it's easy for you to see here the market was going up. And at some point it went sideways and then it started going down. So if you're here and you're new, you know that if something's going up, it's buying, it's going up in value. When it's going sideways, it's sort of stagnant. We call it consolidation. But then when it starts going down, declining in price, that's a downtrend or a sell, okay? So let me clear the charts and I'm gonna type some of that terminology out for you and I won't spend like all night on this. I just want it to make sense. I'm gonna make it make sense for you guys, okay? So we have trends. A trend is it going up or is it going down? Or is it consolidating? So we look at our trends. We always need to know the trend of the market and we look at our higher time frames, our monthly, weekly, and daily, and we'll cover that. If I can start typing. Guys, I've been away from my computer for months and I have missed it so much and it feels weird coming back to it. So we can either be in an uptrend and you will hear people say buy, go long, okay? Or you will hear bullish. So you hear people, when the market is in an uptrend, you'll hear people say buy, go long, or that the market is bullish. Okay, to the opposite side, you have the market in a downtrend where it's short. Well, let's make it match. Buy, the opposite of buy is sell. The opposite of long is short. And the opposite of bullish is bearish. Now, somebody tell me in the chat, why are these markets termed bullish and bearish? Why is the market termed bullish when it's going up and bearish when it is coming down? Okay, and then you hear sideways. So you know, if when you're walking, you can walk forward, which is up, you can walk backwards, which is down, or you can walk sideways. This is a consolidating market, okay? So we have bullish, bearish, and consolidating, up, down, sideways, buy, sell, long, and short. So somebody tell me why, I just saw your message, Grant, sorry. Somebody tell me why a bullish market, an uptrend is called bullish, and a bearish market, why a downtrend is called bearish. Does anybody know how the markets earn those labels bullish and bearish? Okay, I know somebody knows the answer to this question. Oh, go ahead, Rodney. LaTanya's on it. What do you say, Rod? Taylor? So yes, a bull fights and he goes up with his horns. A bear fights and he comes down with his paw. In fact, let me see if I can show you. I had it on my computer at one time, but oh my goodness, it's gone. I had the ForexNChill logo there. Sorry, I thought it was still on there, but I updated from Windows 10 to Windows 11 and it looks like I need to put it back. Okay, so let's just look at a picture of that. Okay. Forex bulls and bears. If you click on images, you see those pictures. You see the bull is going up with his horns and the bear is coming down on all these pictures. And so that's what Wall Street labeled the market as bullish and bearish. Okay. So when the market is going to the upside, it's bullish. So you need to learn the lingo. If you're going to be a professional trader or even trade part-time, you need to learn the language. So we're going to look at this market right here. This right here was bullish. That would be here. You might hear people say the market's headed up. We're going to buy, it's long, or it's bullish. Then we have our sideways consolidation here. And now we have our bearish down market, okay? So now that's the characteristics of how the market moves. And I just showed you some examples. Now the next thing we need to learn after the trend and what the market is doing is an overall bias. Your bias means, you know, just what it says. Is my bias thinking I need to be looking to buy the market? Does my bias tell me I need to be selling the market? Or does my bias telling me it's choppy and consolidated where they love to trap traders? I just need to leave it alone. Think of a moody woman right here. Girls, you know how we can get if we're moody and our emotions are up and down or all over the place. And I know you guys are like that too, especially football season. If your team's not winning and your emotions are like this on Super Bowl Sunday. So you can be in an uptrend, a downtrend, or sideways. That's your bias. When your bias is trending up, you're always going to look to go with the flow and buy. When it's going down, you're going to go with the flow and sell. When it's consolidating, and if you're not advanced, you need to stay out of that. Now, as you become more advanced when the market is going down, if you're advanced, you're also going to know how to take advantage of the pullbacks, okay? Then you'll take advantage of the extensions. Then you'll take advantage of the pullbacks until you get a break and the market reverses to the opposite direction. So, and again, I'm just going to spend a few minutes of this for the newer people, because if somebody had laid down this foundation for me, I know that I would have been successful a whole lot sooner. But, you know, we were taught the basics, we were getting money, but we were having big stop losses, small risk to reward. And we'll have somebody cover some of that at the end of tonight's training. But right now we're going to cover marking up these charts. So the market will go impulse, correction, or a pullback and a continuation. Or it can impulse, pull back, a correction, and get a continuation to the downside. So when it's making these moves, the impulse, correction, and continuation, when it's in an uptrend, where we saw the market here, it's going impulse, correction, and now it's going to make a higher high and a break of structure. So some people will say impulse, correction, continuation, but you have a low and a high. This is a higher low because it takes out this high and makes a higher high. And the market just keeps making higher highs and higher lows and breaks of structure until it gets to a point where you might see it do like a double top and then boom. So you had a low and a high. This was a low, but it didn't create a higher high or a break of structure, and it came. And so this was like a floor. And so it broke through the floor. Once it breaks through that floor, you look for a retest or a pullback. And now the market just starts doing the same thing in the opposite direction. You might get something called a complex pullback. We'll go into that later. But that's how the market is. This is how traders love the market. We love to see the market going up. We love to see the market going down, because this is what we can get, what's called a swing trade with multiple positions where we stack. So we'll sell, 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 and just keep selling until we get to a point where the market reverses on us. And then we start waiting for that consolidation to break out again, make a break of structure, a retest, and then a continuation. So you might hear impulse, correction, continuation, or you might hear higher high, higher low, or lower high and lower low. So just be familiar with the terminology. You don't want to get confused. Okay, so now we're going to talk about time frames. These are candles. Most of you probably know that each one that's printed is a candle, and we're on a daily time frame. So it means that it took one trading day, 24 hours, to make each one of these candles. Some of them are big, some of them are small, but that's what makes those impulse corrections, continuation, break of structure, creates liquidity in the market. And we will talk about that later on as well. But here you see where we had a low and a high, and the market was making internal structure here and finally made a higher high over this, had a break of structure, and it kept making those higher highs. Then it broke and then started making the lower highs. So that is an example of the market reversing. Okay, so I hope that gave you guys who are new to trading a little insight to what we look for when we're looking for the trend. Okay, because as a new trader, you should stick with the trend because the market can get very choppy and very nasty and confuse you. So what we do is called top-down analysis. All right, and it's exactly what it sounds like. We start at the top, which on a standard chart is the monthly. And so if the daily, each one of these candles represented a day, now we know that the monthly, each one represents a month. And you know what? I forgot to turn on my mouse highlight. I'm going to turn that on now because I haven't taught from this computer in about 2 months. Okay, here we go. All right. This will make it easier to follow my mouse. When you see me, when it turns red, that's me clicking somewhere. All right, so this is our monthly time frame. If you look up here at the top, these are your time frames. If I can get my arrow to work with me. So we're going to look at the monthly and the weekly and the daily. We said that when we look to trade, we want to know our overall higher time frame bias. So what is our bias? We're going to break this down by looking at the monthly, weekly, and daily, and we're going to get our bias. So if somebody asks you what are the 3 most important time frames, it's always going to be monthly, weekly, and daily. And why is that? Because it gives us our overall bias. Are we looking to buy? Are we looking to sell? Or are we looking to stay out of the market because it's consolidating? So let me type this out so you guys will have it. 3 most, we'll learn to type tonight. 3 most important time frames. Our monthly, we're going to look for our trading range, okay? Our weekly, we'll look for a trend that is created within that trading range. And a daily, we'll look to see if it's in a trend or a counter trend. And we'll look for key zones. Now you'll hear people say my zones, my POIs, things like that, okay? And when we get to the daily time frame, I'll explain that a little more. So when we were looking at the way the market moves and we were seeing higher highs and higher lows, what we look for when we get to the monthly, it was where was the last low? And it's very obvious, this wick down here. And where was the last high? All right, if you look above this slightly here, this was actually our last high. So we're going to focus on this and this. I like to take this tool called a horizontal ray, and I put it right at the top of my high and at the top of my low. I like my charts very naked. You know, I tell people I like to trade naked and I like to swing. It sounds sort of risque, but it's the way that I trade. That's some traders terminology. I'm gonna make this a little bit thicker for you guys so you can see it better. Style just for tonight. That way you will see that beautiful trading range. And why do we want to box the market in and give it a trading range? Because this is going to allow us, when we go down deeper into this trading range, to find those highs and lows, lows and highs, and those key POIs that we're looking at. Adonai's laughing at me. Brian, I'm glad you like GU. A lot of people love GU, okay? All right, so, and you know what? I didn't know we had maxed out, or I would have upgraded for tonight. It's just been so long. I used to pay $75 a month to upgrade, and then I quit doing these, which I'm going to start trying to do one a month or every 2 months, okay? But on the monthly, we look for our trading range. And I hate that I deleted that. Let me go back and see if I can find it. There we go. I want to just save this right now. I didn't want to delete that. So you guys will see as we walk down what it's doing. Okay, so let's develop a trading range, because this is where, if you don't know how to identify your range, I want to show you a quick trick to help you identify your range. I use a lot of analogies to try and make stuff make sense. Sometimes when people are talking to me and I get confused, I'm like, hey, I need you to make it make sense. So if I'm not making sense, I'm going to make sense right now. The market was here and made a U-turn and drove all the way down here and made a U-turn. Then it came here and made a U-turn, and it came here and made another U-turn. So we focus on the last 2 U-turns, okay? We focus on the last 2 U-turns in the market, because when the market makes a U-turn, it should do what's called a break of structure. So here the market was selling down, okay? Here it started buying back up. You've got choppy. Here was the most recent high at this time. It made a high here, and this high came and went boom, and it busted through this, okay? So here, this would have been your trading range before this breakthrough happened, and this is called a break of structure. That's when we were talking about those higher highs and higher lows, okay? So here we had a high, a low, a lower high, and when this broke through this made a lower low, and this is what you'll hear people talk about as a BOS, or a break of structure, okay? So hopefully the new traders, is this making sense for you so far? Is this making sense for the new traders so far? And we're going to get more advanced as we go on. I just need it to make sense for my new people. All right. So because you have to know, you know, everybody loves smart money, and I swear to God, I love smart money. Smart money really turned my life around when it comes to trading. But the thing I learned, people were so focused on smart money that they forgot where they were in the market. So when they were taking those buys and they were taking those sells, they were getting these little sniper entries and 10, 20 pip moves. And I'm like, wait, well, market structure, I was getting 300, 400 pip moves. There has to be a way to connect the dots and tie the two together. So I went back to market structure to find out, where am I in the market? So market structure is going to answer the question, where am I? And smart money is going to say, where's the liquidity? Where's the entries? Where's the exits? So you have to focus on market structure first. If you don't know oh my God, I just made a new word again. I'm famous for doing that on ForexNChill. I start talking and I just start making up words. But anyway, if you don't know market structure and you're getting in the market, you're not going to know where is the market headed next. Okay, so that's why we're focusing on market structure tonight. So on the monthly, we have identified our trading range, and it's where the market had created this low, and then it created this lower high, and then a lower low. So this was our last high and our last low. Yes, the market tried to head up there, but it didn't make it all the way back. And we'll see why when we go to a lower time frame, okay? I'm going to bring this down so we won't lose it as we move. So monthly, we identify our range. We go up here and click on the weekly, if I don't bypass time frames. The weekly, I love to ask myself, what trend am I in? Okay. When we look at the weekly, we're asking ourselves, what trend are we in? Now, a lot of people, they see a small pullback and think they have a break of structure, but really, if you're making a high, until it breaks that low, it's up, okay? And your low has not really been broken here yet, has it? Okay. The market is making what's considered a complex pullback. Now, people know flags and continuation patterns, but a lot of people are not familiar with the complex pullback. This was one of the first things in market structure that gave me an aha moment. And it helped me realize why, you know, as trend line traders, we were getting our heads busted in the market because I saw somebody mention they wanted to work on trend lines. Let me show you this, right? So you got a trend line and you draw it from the low, which is right here, to the high. Okay, the trend line broke. Well, just imagine this is a 1 hour time frame and it broke, and then you keep selling it, and then it comes into an order block, and then all of a sudden it breaks out and goes to the upside, and you don't know why. Well, that's because this really had never broken trend. This is what's called a complex pullback, okay? And if you go to Google, you can put in Forex continuation patterns. And you know, with smart money, you still need to know these patterns. This is one of my secrets to how I was able to combine market structure and smart money. So I'm looking at these continuation patterns. This is like a complex pullback. When it's pulling back, I start looking at my institutional levels, like liquidity zones, like order blocks, imbalance. And then I know how to gauge how far this pullback is going to come. So before smart money, I knew that this was making a pattern for the market to buy up. But we used to always ask the question, well, when it's making this flag, how do I know when I need to pull the trigger? And we were being taught, well, every time it hits the bottom of the trend line, buy it. So we would buy it, and we didn't know about risk management, about trading emotions. And we were just expecting this breakout, and then it would come and knock us out. Then we would buy again, and it would come and knock us out. But when I learned about smart money, I learned to identify the areas of liquidity. Okay, liquidity to the market is like blood to a vampire. Okay, the market comes after this liquidity, and as soon as it gets it, you get an abrupt reaction and it breaks out. So that's how I learned to take the market structure, connect it with smart money, and gauge my entries. And instead of buying here and keep getting stopped out, I waited and I was patient and I snagged it here, and boom. So when a lot of people were buying here and getting frustrated and getting knocked out of the market, now I'm being patient because I've identified my liquidity and I'm waiting for the market to grab that liquidity, and then boom, I get my entry. I don't have to sit there and draw down day after day after day, get frustrated, get taken out of the trade because now I'm thinking it's in a downtrend, just for it to go boom. So just like you got your continuation patterns to the upside, you got your continuation patterns to the downside. So now when you see this structure being formed, you want it to pull back at least 50%. When it gets to my 50%, I start looking for my liquidity zones, okay? Because in the smart money world, a market, you don't want to get into it until you get at least a 50% retracement or pullback. So when you get that impulse, you want it to come back at least 50%. And you know what? You don't even need the Fibonacci to see that zone, but I'll show you how to tie it in together. Okay, so now if we look at GU and we're looking for our weekly trend, this is really still a trend, a pullback for an uptrend. So if you look up a Forex complex pullback, okay, you see like this right here, it shows you a simple pullback, like impulse, correction, continuation. So it looks like it made a high, a low, a lower high, and a lower low. Now, I know a lot of traders out there still today that this is a high, this is a low. They're like, oh, this is a higher high and a higher low and a higher high. And that's where they get their head busted, because now they're trying to buy the market up. But all that is a complex pullback. A complex pullback means that your higher time frame is selling, like just say this is your hour. And now this is like your 15-minute in here. Your 15-minute made a break of structure, higher high, higher low, but they're just coming after this liquidity, and boom, it's still selling to the downside. Okay, is this making sense to everybody? You don't see over here to the right where I'm marking on the chart, Lupe? Okay. If you look to the right and follow the dot, does everybody see where I'm marking over here where it says simple pullback and complex pullback? Okay. So I get to tease Lupe later. Okay, she's my girl. So I can pick on her. She's having one of her moments over there. All right. So Lupe, follow the dot. Boom. Follow the dot, Lupe. Follow the dot over here. So a simple pullback is like an impulse correction continuation. And we see that beautiful, clear downtrend. But what confuses a lot of people, oh, she sees it now. Everybody give her some applause, okay? This complex pullback made a huge change in my trading because nobody was teaching it back then. All they were teaching, you know, is like impulse correction continuation. I didn't know about the complex pullback. I didn't know about the liquidity zones, but this was one of my biggest aha moments in trading, okay? So your lower time frame has made a break in structure and creating an uptrend, but your overall higher time frame is still in a downtrend, okay? So let's see if we can look at another example of that. I saw one on here somewhere that I wanted to click on. Let's look at this one. Right here, it's ranging. It's making a complex sideways range, and it breaks out. That's still not the one I saw. I saw a very pretty one on here somewhere. This one, some of you might recognize, sort of, it looks like the Elliott wave. So you have impulse, correction, a break of structure, a high. Then you got these complex pullback going on here. Let me change the color on this one, okay? And clear it off. So we're over in the left-hand corner again. You got impulse, correction, continuation, or low, high, higher low, higher high. It creates a break of structure and it pulls back and people are like, oh my God, it made a lower high. It's in a downtrend. Then it comes here and hits this order block with this imbalance, break and retest, and that's gone. And you're sitting here selling the market because you're depending on a trend line on a lower time frame. So trend lines are used for momentum only. They give you the strength of the current market. If it's a good, strong uptrend, or if it's a consolidating market like this, it's giving you a pullback, okay? So start training your eyes to see this in the market, okay? So going back over to GU, so does that, everybody got the complex pullback now? I promise you it's a game changer if you've never been aware of it. And here's one more example right here. So you can Google these things and start making like little index cards and things like that to yourself, okay? So definitely grasp this complex pullback because it's going to make sure that you don't get caught in a downtrend when it's definitely just a complex pullback to take you to the upside, all right? So LaTanya, I remember seeing it for the first time myself too. I'm telling you, complex pullback is a game changer because, and the reason this happens is like on the higher time frame, the structure is clearly there, but most people are trying to trade the 1 minute, 5 minute, 15 minute. They're not looking up at like the 4 hour or the daily and seeing that the true trend is an uptrend. They're down here on the smaller time frame, trying to catch those little sniper entries and not looking left and seeing that it was just coming to grab the liquidity to continue the market to the upside. So if you go back to GU, now we can see that on the weekly, this is really just a complex pullback. So I'm looking on my weekly, and this I'm going to mark right here, weekly, so I will know that I'm still looking at weekly structure is being held, okay? A trend cannot be boxed in, okay? A trend cannot be boxed in, but right here, this price range that has been created can be boxed in. So right here, you had strong momentum. Your trend line broke, but structure did not break. Momentum started started going out. This started getting created, okay? And it's just a bullish flag or a complex pullback because your weekly is still buying. But if you go down to your daily, which is our next time frame, we start looking for our daily trend and our counter trend. Is it counter trend? So right now, your daily is counter trend because you did have a break of structure. The market is making lower highs and lower lows, and it's reacting to each level of liquidity. When you look left, you see all this choppiness. That's institutional order flow, wick touching wick, wick touching wick. There's no imbalance, there's no liquidity. So when the market comes, it's respecting all of these zones because this is just institutional order flow, wick to wick to wick. Okay, there's no imbalance. Right down here, there is an order block with imbalance. Okay, so this is a zone that if this doesn't hold, that I will look to sell the market down to. And this would still be a complex pullback right in here, coming down into that weekly time frame. So this is how I'm trying to marry. I am marrying market structure up with institutional. I see with my eyes the patterns because the market moves off of a computer algorithm. The computer algorithm is seeking levels of liquidity to grab to fill their orders, okay? So we have to identify that liquidity. Now, when we go back to this weekly, we have an order block, okay? The more advanced people are going to understand what an order block is, and the newer people, I don't want to confuse you, but it's one of the most important things when it comes to institutional trading. And so we will cover liquidity shortly, but a lot of times, you know, people teach it as the engulfing candle or the candle that got engulfed. An order block does not always get engulfed. So that's one thing, get out of your head right now. If you hear somebody say an order block always gets engulfed, it's a lie. It's being mistalked, okay? That's one way it got taught to me wrong. Although this one did get engulfed, they don't always get engulfed. And I'll show you some examples later, like right here. This black candle is a bullish order block, but it didn't get engulfed, okay? So even though a lot of times you will see that it did, it doesn't, that is not one of the qualifiers for an order block, okay? So here's an order block. And if you look, remember I was telling you on the other chart on the weekly, you got wick to wick, okay? So I want you to follow this right here. And I'm gonna mark it. What's my best way to mark it? So you see where there's a wick, if you look right and you see a candle or a wick, there's no imbalance. I see a wick, I look right. All right, right here was our first imbalance because here at this wick, when I first looked right, this candle here didn't come back into here. So that was our first area of imbalance going to the upside on this time frame. So what did the market do? It traded back down into the imbalance and gave it a reaction, but it didn't break structure, but it did give a reaction. So you're going to always get a reaction to the liquidity. Okay, so right here you have an order block and it also has imbalance and it also created a break of structure. Okay, so those are the three qualifiers that give you a high probability order block. So this one here, you see there's no imbalance there. It wasn't high probability. When it tapped into it, you did get a reaction, but market came and it's traded down into it now. So the three qualifiers for high probability order block, do this right here. When I'm looking for an order block that I want to trade off of, I ask myself three questions. Did it create a break of structure? Did it leave imbalance? And did it take out an opposing order block? Okay. Did it create a break of structure? Yes. It made a higher high. Okay. Did it leave imbalance? Yes, it did. And did it take out an opposing order block? Yes, it did. Okay. So here was an order block up here and it came and took it out. Does that make sense to everybody about the high probability order blocks? Those are the ones you're going to look for your bigger reactions in the market. They hold a lot of liquidity, okay? So like here's one. Here was one right here. The market traded into it. What happened? It sold off about 3,000 pips, okay? There was imbalance, there was a break of structure, and it took out an opposing order block, okay? What happened again? Same thing. You had an order block here, had imbalance, break of structure, took out an opposing order block, okay? So you see how the market reacts. It immediately reacted, okay? So this had absorbed the liquidity from here. So this came in, grabbed the liquidity from here, and we got a reaction, but look at the reaction here versus the reaction we got here. This gave us a 3,000 pips sell-off and an abrupt. First you had your break on a lower time frame. You can't see it here, but let's do this. This had never been tapped into. So there was so much liquidity left there that it's like running into a brick wall. And if you know, like the ricochet effect, like when you throw a ball into a brick wall and it bounces back. Okay, so if you go to a lower time frame, where we look for entries, you're going to start seeing signs of a break of structure. So that's your daily, and that's your, here's a nice reversal pattern here. Some of you call it the M or the double top. All right, and then it comes back here and y'all automatically sell, but what does it do? It runs liquidity and then it takes you out. If you learn to be patient and wait for the market to grab liquidity, you're going to make a lot more money. You're going to lose a lot less trades. The market will tell you what it's getting ready to do if you will be patient and let it tell you. So here on the 8-hour, you see an order block, but it's not a high probability order block on the 8-hour. Let's move this back. Where is my, right here? See if this is going to let us go back pretty far. All right, now you see how this order block got respected and then it came and broke structure. All right, this is internal structure. When you're looking at structure from the push up, like for your big impulse, this is your external structure from here to here, okay? Internal structure means inside on a lower time frame, it had a break of structure, okay? So this is a 4-hour push and it came, gave a reversal pattern on a lower time frame, made a break of structure and a retest. So let's walk that down, see how low we can go. All right, that's 3-hour, 2-hour, all right, 1 hour. Now look at this. When you get on that 1 hour, I'm gonna zoom in on this so you guys can see it. Here's an order block right here. And really, this green candle was the last buy to sell. This is where the sellers manipulated the market, had you thinking it was going to trade higher, gave an aggressive push. They grabbed liquidity. They will always grab the liquidity when their intentions are to sell it off. They grab liquidity to the upside, okay? So you have this resting liquidity right here in this wick. They grabbed the liquidity. They broke structure. They came back in to this order block, okay? See this order block right here? They came into that. You could have entered in here. Let's see if we can take it down and refine it a little bit more. 45 minutes. Oh, it's not going to let me go back that far. Oh gosh, I hate when I can't go back that far. So now we got to reset and go all the way back. So if I had been able to play that back, we could have probably seen a really good entry on a lower time frame, but the market is not letting us play it back that far. So let's see, the closest we can get, I think, was the 30-minute. But are you guys starting to see this? Is it starting to make sense? And what you also see is it reached in to this big candle that created a breaker structure and left liquidity on the daily, okay? Now it tapped into this. If you look at it on the weekly, it is a weekly order block. So now we went down and we found liquidity inside of liquidity inside of liquidity. So what will happen is the market has layers of liquidity. So this could be your weekly. When you break down your weekly and go inside, you could find a daily order block. Then you could come down in here and find like a 4-hour order block. Inside of that, you're going to find your 1-hour order block. And you can go all the way down to the 1 minute or the 30 seconds. I try not to go any lower than like the 5 minute and sometimes the 3 and 1 minute now, because now when you start refining too much, a lot of times you're going to miss your entry because of spread. And so this is how you refine. So we refined that. We went down into our weekly order block. And then once we went inside that, we were able to find a daily order block with imbalance that broke structure, okay? So now we had that break of structure that happened right here. Spread this over. See how the market just, boom, came through there, okay? The market just crushed through there. And it left all this imbalance. So when this happened, it left ounces and ounces and ounces of liquidity on every single little pip that the market wanted to come back and get. And what are some types of liquidity? I hate teaching this fast. It's like I feel like I'm trying to teach a week of stuff in one class, but let's look at the different types of liquidity, because this is what the market comes after. Market structure is telling you the direction it's going, and liquidity is telling you what it's coming for. Okay, let me make this bigger. So equal highs and equal lows are liquidity. Institutional candles, which are order blocks, are liquidity. Previous daily highs and daily lows, even weekly or monthly, they're liquidity. Buy stops and sell stops are liquidity. Stop losses are liquidity, and imbalance are liquidity. And when you get layers of this, like we looked at some examples last night on my sessions, and we found one trade that had every single one of these incorporated into the trade. Wicks, though, are typically liquidity grabs. And you love to see the wick. When the wick happens and it fails and it comes and breaks structure, that was a liquidity grab. So you see right here, they did a liquidity grab. They broke structure. They came up and created an order block that took out an order block. So right here on the daily, again, you have an order block that took out an order block and broke structure. So this is money, okay? That's money. Look how it traded right up into that imbalance, okay? Traded right up into your imbalance and triggered off. Now you notice a lot of times the market is trading into imbalance these days. They're on to us. They know we're on to them. So the imbalance right there with those equal highs, that is liquidity that could come and get taken at a later time, okay? And boom, there it got taken. So you could have sold off this order block and made some money, but it did not break structure. When it failed to break structure, you see it came and traded into this order block. It wigged in, took liquidity before buying back up, okay? Because this had tapped into the daily, but look, all of this was still left in there on the daily. When you switch back over to the weekly, now you see you had this order block that still is not balanced, okay? It hasn't been closed through. It hasn't been traded through. It's just been wicked. They keep grabbing the liquidity from that order block. Now, what I see and what I feel could happen, this pattern that we're getting right now, let's let this finish playing. In fact, I'm just going to turn it off. Because this is not breaking down aggressively And because they've grabbed liquidity and absorbed it from here several times, I feel that when this market trades back up, it's going to trade through and make a higher high, because this is making a complex pullback, grabbing liquidity from the downside before it trades back up. Okay? Is this making sense to everybody? You have to be able to analyze the market. You have to ask yourself the things like, what would the bank do? You don't start thinking like a Forex trader. You have to start thinking like the actual banker. Like, ask yourself, if I wanted to take these people's money, what would I do? I would sell it here, sell it here, sell it here. Now they think when it comes back, it's going to sell again because they've been taught that this is a supply zone and that, oh, it sold here, oh, it sold here. When it comes back, it's going to sell here. But what is happening is every time it comes into this area, taking liquidity, it's actually building up more layers of liquidity, because now you have these equal highs. You have these institutional candles in there. You have the daily highs. You have the buy stops, because there's people who have trades that are set right above here, waiting to activate buys. You got people who are already sitting here waiting to activate sales because they think it's going to do that. All right. So there's just so much money that is built up. This is like Fort Knox right now. There's just so much money. If I were the bank and I wanted to make a lot of money, I would come and run through that, because I know all these people are sitting here waiting to sell, or these people that did sell on the institutional level, they have their stop losses there. Or there's people that have sell limits sitting there waiting to happen. So smart money wants to take your money. And when I say your money, they're not looking at your stop loss or mine. We don't have enough money for that. One pip takes $1 billion to create in this market. Okay. So just to move this market one pip, it takes $1 billion. None of us have that. When you think they're looking for your stop loss, they're not. Don't flatter yourself. You ain't got that kind of money. And if you do, I'm going to give you my phone number before this call is over, because we're about to be really good friends. Okay. Because we're going to move the market together. But this is just liquidity that keeps building up. Plus now the market is showing you that it's making a corrective move. This is institutional order flow. There's no imbalance. News will come in and boom, push this through there. All right. So if it comes there, and I'm going to show you an example that happened in the past. So if we cut all this off, the only way that you can understand what's going to happen in the future with Forex is to understand what happened in the past, because the market creates patterns, it creates behaviors. And in order to understand what's going to happen next, you either have to sit here and watch the market play out every day and activate your reticular activating system and start memorizing these patterns, or you're going to have to go back test. You're going to get to a level where you're sick of back testing. Now you got to start forward testing. You have to actually watch the market, predict the next move, start dropping these setups on there, taking these trades in demo, and build your confidence. I promise you, once you look at this stuff so much, you will start being able to call the next move. That takes a lot of staring at the charts, okay? But if we take this and chop it off, let me move my little zoom thingy out of the way. If we chop this off, doesn't this look familiar? We have this zone here that every time price came here, it sold. Came here, it sold. It came here, it sold, right? So it had created a layer of liquidity. It came and tapped into this order block. You can't see it on this time frame, but if you go down to the daily, it was making one of those beautiful complex pullbacks, okay? Where people thought it was in a downtrend, but it wasn't. It was just a beautiful complex pullback. Look at that. Does this look familiar? So what happens on one time frame happens on them all. It's fractal. So everybody was sitting here, okay? I took this trade with my team, and when it came in here, I said, do not close your buys. Do not close your buys. We're going to swing trade this thing. We had got in like way here. We got a pullback, got another position. People that I know that are already six-figure sellers were selling the crap out of this, okay? The reason I wasn't selling it is because at this time, I had started studying smart money. I had started studying liquidity, and I was able to take this trade and make about 1,300 pips. And boom, this right here is when we got out of the trade, because now I had caught this bull run, okay? And the complex pullback is now happening on the weekly, because the market is fractal. It happens on every single time frame, but it has to happen on the lower time frame first. So yes, your daily is selling, but your weekly is still buying. So what you need to do is identify where in this market is the liquidity on this time frame that it could pull down to, okay? So look, here's an order block. It tapped into that and rejected. I'm not interested in buying this until it takes out all the liquidity, because remember, when the market is ready to go long, it takes the sell liquidity. When the market is ready to go short, it's going to take your buyer's liquidity, okay? So, Jay Scott, I look for the order blocks. If you were on here earlier, those are the order blocks that I focus on. Let me put that up here again. Is it still on here anywhere? It's on here. These are the order blocks that I focus on. Did it create a break of structure? Did it leave imbalance? And did it take out an opposing order block? And this one did, okay? It broke structure here. It took out this high right here. You see, this one didn't create a break of structure. There's no imbalance. It hasn't taken out any order blocks looking left. This one did. It took out this order block. It broke this high, and it left imbalance. So there's money still sitting in that order block that has not been mitigated. So that's why my eyes are just naturally drawn to this zone because of that, okay? Does that make sense? And yes, Monica said, so the complex pullback could pull back to an order block. Yes, 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 okay? And I'll see, okay, look right here on the daily. You see where that one that we looked at prior, here was an order block that created a break of structure, took out this high here. It left imbalance, and it took out this order block. So price traded back down into that, and then it rallied to the upside. All right, 1,566 pips, okay? Taylor, yes, it will make sense because the market is moved by liquidity. Once you learn to identify liquidity, you have to understand the market has 3 W's. The 3 W's, does anybody here that's on my team or on some of my training, who remembers what the 3 W's are? The market answers 3 questions. In fact, there are three questions you should ask yourself when trading, okay? What are the 3 questions that we ask ourselves when we are trading? Yes, what, where, and when. So our monthly, weekly, and daily, it answers the question, what is the market doing? Is it buying? Is it selling? Is it consolidating, making a complex pullback? So we know what the market is doing, right? Right now, we have answered the question, what is this market doing? Yes, this works on everything, indices, crypto, stocks, everything, okay? We've answered the question, what is it doing? We already know it's on an uptrend, but it's making a complex pullback, which means on the lower time frame, I can be catching sells and buys, sells and buys, sells. Eventually, we're going to catch the big one, and it's going to break out, okay? Because we're going in the order with order flow, the way the market's going. It's still in an uptrend on the higher time frame. So we've answered why, where, goodness, we have answered the what, okay? So now we need to look for the where. Where is it doing it? We've answered that. We had this order block that didn't have enough liquidity to break structure, but you have order block sitting on top of an order block with liquidity. There's so much liquidity right here. There's a lot of liquidity sitting right here. So we want to market the trade down into the liquidity, okay? So that's the where. And then the when, we look for moves on GBP USD. Somebody tell me when. When does GBP move? What's the range, the session for that? And when does USD move? So when would you most likely see GBP USD move? Probably not 8 o'clock at night. Probably not even 9 or 10 o'clock at night. So why would you get in a buy on GBP USD at like 9 or 10 o'clock at night? Okay. When do you think GBP USD would have the most volatility or liquidity or money pumped into it? London and New York, okay? London and New York. So you want this setup to happen. And if you miss it during London, you might get the break and retest and then get the continuation in New York, okay? So what is it doing? It's on an uptrend, making a complex pullback. So where are we looking to buy? We're looking to buy where the liquidity is. So we follow the money. So what is your market structure? Your where is your smart money. Your when, you start focusing on London and New York, and you start looking at like your 15-minute time frame or your 5-minute time frame. If you're not as experienced, there's nothing wrong with trading off of an order block on the 1-hour time frame, okay? So what, where, and when. So answer those 3 questions before you take a trade. Now let's talk about a few more things. I have a special friend on here tonight that's going to talk about one of the most important lessons you will ever learn is proper risk management and proper trade management, something that was not taught to us, and we had to figure it out the hard way. And so now we're teaching it the right way. And I promise you, everything we're teaching you and he's about to teach you, people pay a lot of money for. So we have Confluence. We've worked on our confluences, okay? Versus confirmation. These are 2 things that people highly confuse. So you get a lot of lingo out here in the Forex world, and people will take stuff and rename it and just get you all confused. Somebody tell me the difference between confluence and confirmation. What is the difference between confluence and confirmation? Confluence and confirmation. And I promise you guys are going to be able to unmute pretty soon. It's just like when I'm teaching, I don't like getting interrupted because at my age, I got some timers. And if I'm thinking about something and you interrupt me, I will forget what I was doing. Can somebody tell me the difference between confluence and confirmation? Nobody? Ooh. There we go. Miss Sheila. All right. Right. So confluence is when, yes, it's validating your analysis. Confluence is when stuff starts adding up. When people say, oh yeah, now 2 and 2 makes 4. So your confluence is all the clues and all the evidence telling you what the market is doing and what you're expecting it to do. So once you got your confluence, now we got our confluence, we know we're looking for this to buy. We now need to wait for confirmation. We don't just buy because we're expecting a buy, because you could buy and then sit here consolidation and draw down for weeks, and then it finally takes off, but you weren't able to trade because now you've over leveraged your account. You're in drawdown, your nerves are all tore up, your wife's mad because it's Christmas and you got your money sitting over here floating in Hugo's way and she can't go shopping because you're over here messing up. Okay, y'all know how women are. Okay, so we've found out about confluence and confirmation. Let me get rid of this stuff. Oh my goodness, I've made a mess on my chart. All right, Grace, what you laughing at? You know I'm telling the truth. Somebody's wife or husband's gonna be mad because they're over here messing up, not being patient. Okay, So once we got our Confluence and we know what we're looking for, let me see if I can find this thing on my, give me 1 second. I know it's on this computer. Okay. Do you guys, let's see, resume share. Let me make sure I'm sharing the right thing because I have a lot of blah moments here. Do you guys see something that says retest and entry, how to take a signal? Do you guys see that? Everybody see that? All right. So this is one of the cleanest setups you'll ever take. It happens a couple times a week. The market's not perfect. It's not going to always happen like this. But if you're patient enough as you're learning about liquidity and all this other stuff, and you wait for this, this can be the best setup ever. And I'm going to be the first one to say, shout out to ICT. ICT is the one who founded smart money, institutional concepts. A lot of people, he called it institutional trading, and he called the people who moved the market smart money. So now people have these smart money courses, but they're all based on ICT's teaching. So this is when you're tying market structure in. So you got a low, you see this HH for higher high, higher low, higher high, higher low, higher high, higher low. You got like an equal high or run on liquidity, or it might just be a little M like this. But the most important thing about what just happened is it broke structure. It took out this low. All right, then what happened when it did that? It left an order block with imbalance that created a break of structure and took out an opposing order block, because right here you would have had a bullish order block. And so this right here is a high probability trade that can make you a lot of money, okay? And it's going to be the opposite when you're looking for buy entries. So the market's going down, you got a low, oh my goodness, a high and a low. Lower high, lower low, lower high, break structure, lower low, lower high, break structure, lower low. So now this comes and creates a break of structure, taking out this low. And again, it leaves an order block with imbalance that broke structure, took out an opposing order block. You wait and you take the trade when it comes back into that. Now, if you're not very experienced, take this on like an H1 or a 30-minute or even a 15-minute, okay? If you're intermediate, you can get this on a 5-minute, 15-minute. And then when you're more experienced, you can start looking for it on a 1-minute or sometimes even a 30-second, because this happens on every single time frame, okay? So what we saw on GBP USD is this big weekly push. Now we're getting that complex pullback. We wanted to come into that order block with that liquidity on the weekly. But now we're going to go down on like our 4-hour and our 1 hour, and we're going to have our little ranges here. Then the market's going to do a little dip into there on like the 15-minute and create this structure. And on your 15-minute, you're going to get a little tight entry and boom, catch about 500 pips all the way back up. Okay, so this is our weekly. This is what is the market doing. It's in an uptrend, creating a complex pullback. Okay, so we answered question number 1, what? And then question number 2 was where. So where's the liquidity? Where's the money? What is the whole purpose of doing this? Because when they bought up aggressively, they left that order block, that imbalance. They got this money here. So now they got to sneak their little way down here, institutional order flow. And they're going to grab this liquidity. We're going to wait and we're going to look at like I said, if you're newer, look for this on like a 1 hour. If you're more experienced, go to a 15-minute or 5-minute. It's going to come into this weekly zone on a lower time frame, give you like a little descending channel, break, retest. It's going to make the same thing on a smaller time frame. So now you can get that 20 pip or less stop loss to get a 500 pip move. Okay, is that making sense to everybody? Kay, you can't draw the order block, but I can show you how to find it. Let's say the order block is a candle that is printed on your chart, and I'll show you that in just a second. I'm going to teach about 10 more minutes, and I'm going to let the money coach take over. Yes, I will post the recording. Where, Monica, where did you see the invite? Because I'll post it in there. Okay. Now, sometimes you'll see news come, and this will happen. You got this zone here, that liquidity. News comes and boom, dips into there real quick, then boom, boom. And that's when you have to snag that trade. Okay. So I'm going to show you an example of that on gold. And then I'm going to turn it over to the money coach. Okay, let me give a new share here. So this week on gold at 2 p.m. got a really sweet setup because we know structure. Okay. And we know liquidity. Right here is the trade. So what's happening with gold is basically the same thing that is happening with GU. If you go and you look at your weekly, so you guys don't see gold, all right, you should be able to see it. If you look at your weekly, let me scrunch this in a little bit. You see gold has been making a complex pullback, okay? Here's an order block here with all this liquidity. I've been wanting to see gold trade down into this, okay? You guys still don't see gold? That's weird. You know what? Zoom did this the last time. Zoom did this a few weeks ago. You see it now? I think Zoom has a lag on the weekends. So you guys see gold? What did I just put on the, so some people see it. What did I just put on the chart? Then I'll know Zoom is having issues because this happened a couple weeks ago. Yes, a check mark. So this is gold, okay? So if you see, there's that same complex pullback being made on the monthly. Look at that, guys. There's a complex pullback on gold on the monthly. If you do this, look at that. But I'm gonna tell you the reason I did this. On the monthly is a complex pullback. There's an order block. On the weekly is a complex pullback. There's an order block with liquidity and equal lows. Order block, imbalance, break of structure, equal lows. Okay. Excuse me. If you go down to the daily, one of my favorite reversal patterns is a descending channel. So I looked and I asked myself, if news is coming out at 2 o'clock and this thing is here, right here, this liquidity, let me zoom in. Okay. Right here, this wick that was sticking out on the lower time frame. This happened right here. And this broke through it, and then it created equal lows, which is liquidity. But underneath all of that, on a higher time frame, we had an order block with imbalance. I forgot what time frame it was. We actually broke this down the other night. Okay. So there was a zone in here that had an order block right here that hadn't been tapped into. So the reason they have news is so they can come grab liquidity, manipulate you and sell, and then boom, take off buying, right? Because they got to have you thinking it's selling. So this is where I told you, you tie market structure in with institutional trading. On your higher time frame, you looked at the pattern it was creating. It's creating a descending channel, which is a retail reverse pattern, coming into an area of liquidity right before news, okay? So Sorry, my phone keeps blowing up. So we had the reversal pattern coming into a zone of liquidity, and we had news on the way. So that let me know that news is built for liquidity. It's built for manipulation. It's going to come in. I've caught this so many times on gold. It's crazy. They're going to come in and grab the liquidity. You see this wick? That's liquidity grab. That's manipulation. All right, so let's look at it on a lower time frame. So you have to have that higher time frame bias. The only way to catch news trades is to know on a higher time frame what you're expecting the market to do, and you have to know it in advance. Okay, when you go down and you start looking at the lower time frames, you see these equal lows, grab the liquidity there. All right, and it came in at 2 o'clock. You see this candle? If you look at the bottom, it says 1400. This was news. This was FOMC. FOMC is to grab liquidity. All right. Good night, Maria. Thank you for getting on. And you still don't see any structure on the 15 minutes. All you see is that nasty wick that came to take out people's money before buying up. Now, once you get down to the 5 minutes, you see it created an order block. This order block grabbed liquidity, snapped back up, traded up, took out this order block, and traded back into it. Okay, this right here is my Fibonacci. This is my premium and discount, and I just really don't have enough time to go into it tonight. We'll do a longer session maybe in January. It's the holidays and I'm tired. But this right here, when it turns pink, that's when I know it's dipped into 50% of the order block. You could have traded off this order block and caught that whole gold move to the upside. Okay, so let's go to the 3 minute. Now there's that same order block. Price tapped down into 50% of that order block. And I can't believe that Zoom is lagging like this. It did it the last time on a weekend. Much money as we pay them. But you see here, I told you all order blocks do not get engulfed. This is the order block, or what some people call the FU candle, because they sold aggressively, grabbed this higher time frame liquidity, left that wick, and immediately bought up, broke structure, traded back down into 50%, because the people who want to buy the market will aggressively sell the market. So their sale candle got caught here, order block, a block of orders. So they pumped billions of dollars in here to sell, just so they could get gold at a dirt cheap price. Then they pump money in to buy it. So they have to come back and they want to close out at least 50% of what got trapped here. So maybe they'll drop 20 million into a big sell candle, okay? So they got 20 million stuck here because they had enough money to push price down. Then they throw 80 million into a big buy candle that leaves this order block here. They come in, retest it, and then boom, they were able to close out the 20 million. They made money off the 80 million, secured more buy orders, and then the market takes off. I apologize for the lag. It is Zoom. It is not me. So does that make sense to everybody? There's the 3 minute, and let's see if we can get the 1 minute view. And there's the 1 minute view as well. All right. But you see the clearer move was on the 3 minutes, that big 3 minute order block, and the 5 minute, the big 5 minute order block right there. Can you guys still hear me? I know we have a lag. Coach Chris, let me find you and make you the co-host. Is all this making sense to everybody? Let me see if he's on here. I am making you co-host so you can do your thing. All right, before he starts, I want to tell you guys, when you get ready to pull the trigger, you need to know how much money you're going to lose if you lose the trade. The most important thing about trading is protecting the money that you currently have. The second most important thing about trading is making money with the money you currently have. But to make money, you have to protect the money that you have. So the money coach is going to be here to talk about risk management. I can tell you that the people on our team who are consistently passing FTMO month after month after month, there's several people on this call tonight who have multiple FTMOs, like Miss Sheila. She just passed another. I'm not going to tell her age, but I'm going to tell you, I turned 54 this month. Miss Sheila's older than me, so I can call her, yes, ma'am, Miss Sheila. Miss Sheila just passed another 200,000 FTMO. Okay. And we're like in our 50s and 60s, guys. And when we started making money, it's when we learned the risk management portion. You can take a person who trades and wins 9 out of 10 trades. Okay. Let's say this person took 10 trades and they won 9 of them, and they let that one trade come and take every bit of that money back. That's what happens to 99% of traders who fail. It's not that they don't know how to trade. There are so many people who can mark up a chart and pull the trigger, but they don't know risk management, they don't know trade management, and that's why they lose money. So 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. I'm turning it over to the #1 money coach, Mr. Chris. He's going to teach you how that if you are even taking 50% wins, if you only win 50% of your trades and you do exactly what he's getting ready to tell you, you can be an extremely profitable trader. All right, money coach, you there?
I am here. How's everybody doing? Talk to me in the chat. Can everybody hear me?
Do you want me to allow everybody to unmute?
Sure. This is what Gigi has told you. I don't know if you noticed, but if you hold your space bar down, you can temporarily unmute. Once Gigi sets it to where that you can unmute yourself, which is what I want you guys to do. I want you to hold your space bar down and you can temporarily unmute, talk, and then once you let go of your space bar, it'll mute you back again. Okay.
Okay, this is going to mute you, so I'm going to do it now on the count of 1, 2, and 3. All right, so everybody should be able to hit your space bar and say ForexNChill. Hold your space bar and say ForexNChill.
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 Jay Scott, love the voice. Is that what you're saying? You flirting with me, Jay Scott?
Yes. No, I'm not. No, I'm not. No, I'm not. I just love your voice. No, I'm not.
All right.
It's Friday night, ForexNChill after dark.
Jill, exactly. All right. So everybody just hold your space bar down, talk to me, say something to me, and then let it go and mute yourself back. Do it. Everybody try it. Start.
Hello.
Hello.
Very good. That way that it'll unmute you when you want to talk, and then it'll mute you right back. Okay. So that we can keep the recording very clean. All right. Let me ask you this. How many people are in this, are watching this ForexNChill, don't know anything about Forex trading, anything about, this is your first time joining anything? I know I invited somebody who reached out to me. I don't know what level she's on, but I need you to tell me who in here, this is your first time, you don't know anything about the Forex market. Type it in the chat. Let me see, anybody? Brand new. Okay. Hi, Joan. Is it Joanne? Crystal's brand new. Okay.
I had several people on earlier who were dropping
Pamela
one.
is brand new. Okay. This is good. This is very good. This is what I want to know, because I really, really want to make sure that I understand the level. I want to break this down to where everybody can get it. All right. So I need all of my intermediate people who know all about this stuff. I need you to support these people. Crystal, the Pamela, and let's see, who else is that? And Joanne, okay? And because at some time or another, you didn't know what a pipette was. You didn't know what a pip was, okay? So I need you guys to be patient so that we can kind of bring them up to speed, and then we'll kind of just go through this briefly. We're not gonna be here long, all right? But I just want to kind of bring people up to speed because, as she said, risk management is really, really so vital. It is extremely vital, all right? She said, kind of as an introduction, you really, really want to be able to protect the money that you've already made, and that is the goal. Here's the deal. Every time we take a trade, we want to be able to assess how much money we're willing to lose. Not that we're going to lose. How much money am I willing to lose on this particular trade, okay? If I have $10,000 and I lose $100, am I beating myself in the face? No, because I still have $9,900, okay? Now, if I have $10,000 and I lose 5,000, yeah, I'm sick. I'm sick to my stomach. Versus losing 100, I lost 5,000. I would be very, very sick. And a lot of us, if not all of us, have been there because we did not know what? Risk management, okay? Risk management. One, everybody type in the chat, can you see my screen? You should be able to see my screen. It should say Sunday Fun Day. Everybody see that?
Yes, I'm driving. Can't type.
Very good. Thank you. Very good. All right. Now, here's the deal. Risk management. The definition of risk management is risking a certain predetermined percentage. And for all intents and purposes, for this particular exercise, we're going to just say 1%, which means if I have $1 and I lose $1, if I have $1 and I lose a penny, am I mad? No, because I still have 99% of my money, all right? If I have $1 and I lose 70 cents of it, I'm sick because I'm only left with 30 cents, okay? This is what risk management, managing your risk, managing how much money you're willing to lose, not how much money you're going to lose, because you may win, but at least I know how much money I am willing to lose, which means 1%. If you have $10,000, and this is our first, this is the first lesson that I want you guys to learn. Let me pull up my calculator. Okay, can everybody see my calculator? You press the space bar and let me know and talk. Can you see my calculator?
Yeah.
Very good. Very good. If I have $10,000 or $100,000 times 1%, which means times 0.1. If I have $100,000 and I lose $1,000, this is still gonna leave me with $99,000. Am I mad? No, I am not. Okay, who is that is unmuted and has not muted back? Thank you. Very good. So if I have $100,000 and I lose 1,000, I still have 99,000 left. I'm not mad. Okay. If I have $100,000 and I lose 80,000, I'm sick because I'm only left with $20,000. This is what risk management means. Risk management means I am managing how much money I am willing to lose. Keyword, willing, because you may win, okay? But if worst case scenario happens and I lose, I need to know how much money I am actually going to wage on this particular trade. Especially my new people who don't know anything about this. Does this make sense? I need only my newbies to tell me, does this make sense? Thank you, Joe. Is it Joanne? Is that how you pronounce your name, Joanne? Unmute yourself. You want to press your space bar?
Yes, it is. Sorry.
Very good. Thank you.
You're
Chris.
correct.
Okay, Ronan. Very good. Good. So this makes sense. If I can manage how much money I am willing to lose, okay, then this is what protects my capital. Okay. Let's just say you start with $1,000. All right. Now, my people know in order to find out, because this is what $1,000 looks like. Now, in order to know what 1% of any number is, I need to take my decimal point and move it over twice. If I move it to the left twice, what would this say? I need my new people to tell me who don't know anything. If I took this decimal place and moved it to the left twice, what would this number be? How much would that be? $10. That's a cheap way to know how much 1% of any number is. All you do is take the decimal place, move it to the left twice. This will tell you how much 1% of any number is. So 1% of $1,000 is $10. Because if I move the decimal place to the left twice, it will look like this. It will look like this. I moved it to the left twice, $10, okay? What is 1% of $500,000? What is 1%? How much?
5,000.
5,000, exactly, because we moved the decimal place to the left twice, and that number left is $5,000. If I have $500,000 and I lose $5,000 and I'm left with $495,000, I am not mad at all. Now, if I have $500,000 and I lose 400,000 and I'm only left with 100,000, I'm sick to my stomach because I will have lost too much of my money. This is what risk management is. Risk management says, how much money am I willing to lose? I go into every trade saying, I already know I'm only going to wager this much. And we are advocating just on the front end, 1%. Does everybody understand what I'm saying, what I mean? That means you would have to lose 100 trades in a row to lose all of your money. So what are the odds of you losing 100 trades in a row? Very, very, very not likely, okay? All right, so this is what risk management is, okay? So if we have $10,000 and we move the decimal place to the left twice, we are left with $100. This is how I understand 1% of my, if my balance was $10,000, 1% is $100, all right? Now, let me educate you all again on some other stuff so you'll understand. Pipettes. See, I think that's spelled wrong. Pipette. Forgive me. But pipette, 10 pipettes all right, 10 pipettes equals 1 pip. Now, I just need my new people to I need you all to just focus in on this particular statement. 10 pipettes equals 1 pip. How many pipettes does it take to equal 1 pip? Type in the chat. 10. All right, 10 pipettes equals 1 pip. 10 pipettes equals 1 pip. 10 pipettes equals 1 pip. I am not repeating myself because I'm slow. I'm repeating myself because I want you guys to get it. 10 pipettes equals 1 pip. Now, when you secure a lot size, and 0.33 in money terms is 33 cents, correct? Everybody unmute yourself and talk to me with your space bar. This is 33 cents. Does everybody see that?
Yes.
Okay, if this is 33 cents, when you secure your lot size, Your lot size is saying, I am risking 33 cents per pipette. Okay? 33 cents per pipette. Now, if it takes 10 cents to equal 1 pip, 10 pipettes to equal 1 pip, then it would take 10 of these 33 cents to equal 1 pip. And if I multiply this 0.33, okay, let me go back to my calculator. All right. If I do 0.33 times 10 equals 3.3, which is $3.30. Does everybody see that? Is this not $3.30? Correct? Now, an easy way to do that is to take this decimal point and move it to the right one time. If I would have taken this decimal point and moved it right here, one digit, 3.3, that's how you would have known. Your lot size means if I risk 33 cents per pipette times 10, every pip that moves, I'm risking $3.30. Do you all understand what I just said? Who doesn't understand what I just said? I need you to be very, very transparent with me. Who does not understand what I just said? So everybody's on the same page? Okay. When you have a lot size of 33 cents, that means this is how much I'm waging every pipette. Okay. And how many pipettes does it take to equal 1 pip? 10. If I multiply 33 cents times 10, I come up with $3.30. So for every pipette, every pip, I will win or lose $3.30. Okay. Now, this is where we begin. And I'm just going to give you this right now. Let's just say our starting balance is $10,000. Okay. If we know that our starting balance is $10,000, what is 1% of 10,000? If the decimal place is right here, which is here, if I moved it to the right twice, or to the left twice, what would this number be? $100. Correct, Gwendolyn. Correct, Keisha. Correct. Type it in the chat, everybody, because I need you to see this for yourself. Because Keisha answering and Gwendolyn answering for you, you won't see it. Thank you, Ronan. Thank you, Grace. Thank you, Becca. Thank you, Latanya. Thank you, Pamela. Thank you, Delise. Thank you. Type it for yourself. If I move this decimal place to the left twice, I will see $100. All right. So on this first trade, I'm only risking $100. This is how much I'm willing to risk, is $100. Now, this particular trade called a stop loss of 39 pips, which means what I'm going to do here, I will divide $100 by 39. Okay. 100 divided by 39 equals 2.56. If I move this decimal place to the left once, this shows me 0.25 will be my lot size. Do you see that? That means for every pipette, I'm risking 25 cents. 25 cents times 10 is $2.50. If I multiply $2.50 times 39, watch this. $2.50. Sorry, $2.50 times 39. It should equal close to $100. You see that? 97.5. You see that? This is how we know how much money we're really willing to lose, okay? This particular trade won, and it went 71 pips. So we multiplied 71 times $2.50. So if I go back to my calculator, 71, which is what we won, times $2.50 equals $177.50. And look, $177.50. That's how much we won, okay? That's definitely, now if I just stop right here, just so you can understand, the importance of risk management means I know how much money I'm willing to lose. I'm willing to lose 1%, which means I would have to lose 100 trades in a row to lose all of the money that I have. All right. This is what risk management is. If you can be the most amazing analyst, Gigi is an amazing analyst. She loses trades. It's very rare that she loses 100 trades in a row. She probably has never lost 100 trades in a row in her trading life. Okay. Had we known risk management when we first came in the game, we would have been a lot more profitable, a lot more richer at this point. Please, can you go over again, Michael? All right, what part do you not know, Michael? Unmute yourself, Michael.
The odd GPY facts.
Okay. This is our starting balance. Michael, I want you to stay unmuted. $10,000. What is 1% of 10,000? If I move the decimal place to the left twice, what number do you see?
100.
All right, $100. So you divide $100 by the stop loss, okay? If you take, I want you to take your, are you driving or are you a bit somewhere?
I have my notebook here.
Okay, I want you to divide $100 by 39 and tell me what you get. What answer do you get? 100 divided by 39 equals 2.56. You see that?
Yes, please.
If I take the decimal and move it to the left one time, I would see 0.25. You see that?
Yes.
All right. That will be my lot size. My lot size will be 0.25. Okay. This is how I determine my lot size. Okay. So if I go back up here, my starting balance is $10,000. I know that 1% of my current balance, which is $10,000, is $100. What you do is you divide 1%, which is $100, by the stop loss. This particular stop loss on this example is 30 pips. $100 divided by 30 pips is 3.33. I move the decimal to the left one digit, which means my lot size would be 0.33. You see that?
Yes.
Okay. So if I have $10,000, you have already told me, Michael, that 1% is $100. I would divide 100 by the stop loss. And what is the stop loss right here, Michael?
39.
39. If I divide 100 divided by 39, I see 2.56. If I move this decimal to the left one time, what number would you see? 0.25. You see that?
Yes, please.
Good. This is how you determine your lot size when you enter it on your trade, 0.25. If you have a stop loss of 39 pips and your lot size is 0.25, if it hits your stop loss, you will only lose $100. You see that, Michael?
Yes, please. Thank you.
Right. But we won the trade and we won $177. You see it?
Yes.
Okay, very good. Now, if I took $177.50 and added it to this $10,000, this is how I got my balance of $10,177.50. Now, what is 1% of this number? If I move the decimal to the left one time, what number would I see? Somebody tell me. Unmute yourself.
101.77.
Yes, $101.77. Does everybody see that? Include the 77 cents. Michael, so you see 101.77. Okay, exactly. Now, on the next trade, this next trade is 30 pips. So you would divide $101.77, which is 101.77 divided by, what was the stop loss? Stop loss was 30. Okay. Now, this is 3.39. If I take this decimal and move it to the left one time, what number would I see? 0.33. Does everybody see that? Correct. And this is how I got my lot size, 0.33. This lets me know that if I lose this trade, I'm only going to lose $101.77. But I won this particular trade and I won $990. Okay. This is what risk management is. Gwendolyn asks, do you always put a stop loss to control risk? Absolutely. You must have a stop loss. You must. This is the reason of a risk management. That means if it hits this stop loss, I know that I'm only going to lose this amount of money. You understand that, Gwendolyn?
Yes, please.
Yes, you always put a stop loss. This is what lets you know that you are willing to lose this amount of money, okay? And that is really all that risk management is. Now, here's the thing. How important is that? Absolutely important. Because if you don't put a stop loss and that thing just tanks, then you can lose your whole account. And you don't want to do that. You can lose everything. Absolutely, Crystal. You can lose your entire account. So if you have a $10,000 account and you lose the whole 10,000, would you rather lose 10,000 or only lose $100? $100. Everybody knows that. So the whole point of it is risk management is absolutely, risk management in essence is jumping out of an airplane with a parachute. How many people would jump out of an airplane without a parachute? Nobody. Nobody in this chat would do that. A stop loss means that I know where I'm going to be saved, period, point blank, end of story, if it particularly hits this. And then my lot size along with my stop loss will tell me exactly how much money I'm willing to lose, which is 1%. I'm not jumping out there. Exactly, Rod. Exactly. Okay. Now, my new people, do you understand what I mean when I say risk management? Because you're managing your risk. You know how much money you're willing to lose. Okay. If you have $100 account, 1% of $100 is $1. If you lose that trade, you're only going to lose $1. I'm not going to stress. I'm not going to pull my hair out because I lost $1 and I'm left with $99. That doesn't bother me. Okay. What would bother me is if I have $100 account and I lose $90 and I'm only left with $10. That's not proper risk management. Okay. I have a demo account that's open right now. It's a $200,000 demo account. I lost one trade today and it was $500. Am I mad that I lost $500? No. Why? Because I still have $199,500 left. You see that? That is proper risk management. And mind you, this particular trade was taken with the crisscross EA. Okay. I lost the trade, but I only lost 2%. Actually, it was not even 2%. $500 on the $200,000 account is actually 0.5%. So I'm still winning. Risk management is jumping out of an airplane with a parachute. Nobody in this room would do that. None of you guys would do that. You have to know how much money. And when you do that, it takes the fear out of losing a trade because you'll know, I know how much, because I can lose 9 trades and win the 10th one, and I will win all of the money back that I lost. This is what risk management does for you. Okay. So we will multiply 0.33. We will multiply 0.33 times 300 to get gold TP. No, we will actually, when you have, okay, Latanya, I want you to unmute yourself. Lot size means 0.33. Now, this means I'm risking 33 cents per pipette. Now, how many pipettes does it take to equal 1 pip, Latanya?
That's right. 10.
10. Now,
10,
so
10% equal 1 pip.
so if you multiply 33 cents times 10, that's what tell you how much you would get per pip. Now, how much does 33 cents times 10 equal?
3.30.
Say it again.
$3.30.
Times 10, $3.30. So that means for every pip, you went 300 pips. That's how many pips you went. So you would multiply $3.30, $3.30 times 300. You will win $990. You see it? Because it went 300 pips, not pipettes. It went 300 pips. Okay? You see that?
Yes, thank you.
Correct. So let's just kind of talk through a few of these. All right. We're just going to talk through it. And I want you guys to unmute yourselves. And I want you to do the math. Everybody should have a calculator. You have to have a calculator in front of you to do this. Now, if we have a $10,000 account, we know that 1% of our $10,000 account is $100. All right. We would take $100 and divide it by 39. Once we get the number, we will move the decimal place to the left one time, and that would tell us our lot size, 0.25. That means that we're willing to risk 25 cents per pipette, which means 10 pipettes equals 1 pip, which means I'm going to win or lose $2.50 per pip. All right. I won 71 pips. 71 times $2.50. Somebody tell me what that number is. 71 times $2.50. What is the number? What is the answer?
177.50.
All right. That's how much we won. We add this to our $10,000. This is our balance. And this is how we got this. All right. Now, somebody tell me what 1% of this number is. Move the decimal place to the left twice. What is 1% of this number?
101.77.
Very good. Take that answer, 101.77, and divide it by 30. What number do you get? Whoever that is with all of the loud people laughing in the back, mute yourself. Say it again.
3.39.
3.3. Now, if I move the decimal to the left one time, I would see 0.33. This is how I got my lot size. All right. We won 300 pips. So that means if we risk 33 cents per pipette times 10 will be $3.30 per pip. What is 300 times $3.30? 300. 990. We won $990 on this trade. Add $990 to our current balance, and this is how we got $11,167.50. Okay. Now, what is 1% of this number? Somebody tell me.
111.67.
$111.67. All she did was just move the decimal place to the left twice. We saw 111.67. All right. Divide that by 35, and that gives us 3.10. We multiply we take the decimal place to the left once. Our lot size is 0.31. All right. That means for every pip, we are risking $3.10. We won. So what is 16 times $3.10? Use your calculators. What is $3.10 times 16? What is that number?
$49.60.
$49.60. You see that? That's what you profited. If you add this to your current balance, this is how you got $11,217. All right. What is 1% of this number? Somebody tell me.
112.17.
Correct, $112.17. If you divide that by 20, you will see 5.6 whatever. You move the decimal place to the left. This is how we got our lot size, which is 0.56. And then from there, we won 20 pips. Now, so 20 times $5.60 equals what? 20 times $5.60.
112.
$112. And this is how we got our answer here. We would add this to here. And we would just keep on replicating. The rest, you see, we took losses. We knew we were only going to risk $100.
Excuse-
Yes.
Okay, so I realized that from your journal here, right? You only risk your stop loss is under 40 pips. What's the reason for that?
Say that again.
Your stop loss, how you came about this stop loss?
You're going in and out. I need you to say it one more time. Is your internet is going in and out. So that's why I'm asking you to say it again. Say it again.
Okay, so I would like to know how you came about your stop loss.
The stop loss is given. Okay, all of this, what you're seeing right now are signals that were given. Okay, now some people who are on here are not members, are not affiliated with B. Okay, so let me do this right here. Let me stop sharing. Gigi, are you still here?
Yes, I'm here.
Okay, can you share your screen and show them what B is and show them what all of the signals that are called? These answers are, the trades are given to you. This is why you're here. If you join B, and I am, I'm not trying to pitch, I'm just telling you scenario based. If you join B, they have signals that they give you. They give you trades. They will tell you what your stop loss is. They will tell you, all you have to do is figure out your lot size, which is what I just told you. Take your balance, find out what 1% is, all right, divided by the stop loss that will be given, all right? So you have shift trades, okay? And that's what we're talking about. So Gigi, kind of show them what B offers and things of that nature so that everybody will know what's going on. And shout out to the people from Trinidad and Tobago. This is thank you very much. This is an international call. So show them what shift is and show them what comes with B. If you are affiliated with B, they will give you, people who got signals, they give you the stop loss. That's all you need. Once you have the stop loss, you just take your balance, find out what 1% is, and then divide it by the stop loss. That will tell you your lot size. Okay.
Okay, well, first, if you're in the ForexNChill Telegram, the free Telegram, I just dropped a trade manager that you can put on MT4. Okay, for those of you who want to protect your profits, it has multiple take profits and it has a trailing stop loss because we're big on risk management. As you see that, you know, I always know who the serious traders are and the people who are going to be successful because they stay on for this part. It's okay to be able to catch a trade, but if you can't keep a trade and manage a trade, you're not going to succeed. So y'all can download this and put it on MT4 and put like 3 take profits. So like, if y'all been seeing me post pictures of my auto trader, I have my auto trader set to where at 12 pips, it moves my trade into break even plus 2 pips, okay? Then when it hits 20 pips, I have it to where it closes out 50% of my trade, and then it creates a trailing stop loss. So you want to be able to manage your trades. And if you're working or you got kids or you don't want to have to babysit your trades, that's what indicators are great for. These EAs are great for. But there you go. But and like he said, this is not a plug. I had no idea he was going to do this. I was actually sitting here in the background about pop me some popcorn. I'm an educator and I teach 3 nights a week. And you see, when it comes to Forex, I'm the top Forex educator on there. Go Gigi, go Gigi. He teaches binary options, but this is a company out of Dubai. So I teach 3 nights a week. I teach market structure on one night. I teach smart money on one night. And I do a weekly outlook. But we do give trade signals. I have a team chat where they already have access to the free indicator and additional education. And we got trade signals where we tell you where to get in, where to put your stop loss and everything. That's basically it. You get education and you get to make money and you get all the traders and everything. You get to hang out with me on the days that I'm nice and the days that I'm sleepy and irritable and everything. You get the full GG.
All right. So the stop loss is given to you. That was the question that you asked. So it takes the guesswork out. So, you know.
Now the auto trader, it actually gets you in the trade. It if you put 1% risk, it will pick your lot size, your stop loss, and all that. So, but that's for another call.
All right.
Okay.
Trust me when I say
But
big
can
things
this
are coming with that.
Go ahead. What were you going to ask?
Yeah, so this trade manager that they dropped in your Telegram, can I use this on a EA itself? Or that's simply for your EA?
No,
that
you can
you
use
have?
that on anything. You can use that on the trades that you take yourself. Like if you're running trades, you can use that EA. You can use that on anything.
Okay. But you
Like,
must take it on
so what you want
so
to
but
do, if
when
you
you
have
using it,
if you
must
have
be on your computer.
MT4, yeah, it has to be on a computer, or if you have like a tablet, you can have like a remote desktop, a VPS, and run it through that. So yeah, unfortunately for smartphones, for cell phones, they don't make anything like that, unfortunately. But you can get a remote desktop, but it's hard to use them on your phones, but it's easy to use them on your tablets.
Okay.
But
So
if you're going to get serious
sure.
about trading and
Right.
you want to catch those good trades and not worry, these trade managers make it, less stressful. So I'm gonna share my screen one more time. Where is my, all right, go right here, let's go back. Okay, so let's just say somebody gave you a signal. Like when I drop signals, here's the way I like to do it. I like to use the long and short tool because it gives you, let's just say we were buying this. And I just did it backwards. Hold on. Okay, so I would have entered at the 50% of my order block. Gosh. All right, the gray part is my stop loss. And my entry is right here at the green, and up there would be my take profit. So if somebody's giving you your stop loss, they'll have it typed out. Gosh.
It's lagging. We don't.
Right. I know. I don't know what's going on.
I know.
And then you'll have your entry right here. And then you'll have your multiple take profits. Like you'll have like take profit 1. My mouse is acting stupid too. Take profit 1, take profit 2, and take profit 3. All right, so let's just say this is your trade. They'll tell you this is your entry. They'll say buy gold now. Here's your stop loss. Here's take profit 1.
Your 5 minute. We don't see any of the green.
Gosh.
Anything. I don't know why. For some
All right,
reason.
well, it'll catch up. I don't know what's going on with Zoom. It did this the last time I had Zoom.
Okay, we see
I
it now.
see it
We see it
now.
All right. Yeah, it did this the last time. I'm going to have to send an error report to them. All right. So this is called a long tool, which means you're going to be buying the market. So the gray area is your stop loss. So your trade would come down into here and hit this, then you would be out at a stop. And right here is your entry. And then you got your take profits here. So you would calculate based on your account size and the size of your stop loss, just like Money Coach is showing you. That's how you get your lot size. So you need to know your stop loss size and your account size. These are the two things that determine your lot size. A lot of people will try to tell you, well, if it's $1,000 account, just use a 0.10. That's $1. That's 1%. That is not right. Okay, if you have $1,000 account and you put a 10 and it goes 10 pips against you, then yeah, you've lost $10, 10%. But if it goes 30 pips against you, now you've lost $30, 3%. I said 10%. If you lose $10, you've lost 1%. But if it goes 30 pips, now you've lost $30, you've lost 3%. So you can't just say my account is $1,000, so I'm going to put a 10. And that's the way I was taught. And it was so wrong. That's why I tell you guys, we were taught so wrong. Everybody has seen that little chart that floats around that says, oh, if you got a $1,000 account, just use a 0.10. If you got a $100 account, use a 0.01. That is so wrong. And that's why we like having these sessions, because again, we were taught the wrong way. Okay, we were taught the wrong way, so we're here to teach it the right way. So $1,000 account, somebody tells you just use a 0.10. That works if you have a 10 pip stop loss. That's going to be 1%. If I draw this right, Jesus, y'all can tell I'm sleep deprived. But if you go in 30 pips drawdown, now you've lost 3%. Okay, so try to stick to 1% or less until you become very skilled. Very skilled. I see people risking 10% on a trade. That means you can only lose 10 times and all of your money is gone. Okay, so if you, here's the way I like to explain. I love to have Coach Chris teach this. Here's the example I always like to leave people with. Let's say you got 10 trades, okay? You lose 5 and you win 5, okay? Every time you win, let's just say you win 2%. And every time you lose 1%, because we already know we're not going to risk more than 1%. That just means you had like a 20 pip stop loss and a 40 pip take profit. So if you lose 5, you've lost 5%. If you win 5, you've won 10%. You're up 5% for the week. All you need is 2 weeks to pass FTMO or any other trading firm. Does that make sense? That's why we like to teach it like this. Here you have your winners and here you have your losers. And let's just say every trade you risk 1%. If you lose 5, you're never going to lose more than 5%. Okay, let's say over here, the first one you got 1%, second one you got 2%, the third one you got 1%, the fourth one you got 2%, the fifth one you got 1%. Now you got 1, 2, 3, 4, 5. You got 2, 4, 6% up for the week. You still are up 1% for the week. You still have more money than you started with. Okay. All right, so I apologize that there's a lag on my end, but hopefully that made sense. I'll turn it back over to you, Coach Chris, before we end.
Oh no, this is one. Let me say thank you to Gigi for asking me to be a part of tonight's Forex and Chill. If you've never been on Forex and Chill, know that this is a very, very, very credible platform as far as Forex and Chill is concerned, to where she started years ago, and just, you know, out of the kindness of her heart, people who weren't affiliated with anybody that wanted to learn how to trade. And so she's been teaching this. She's been doing this for several years. And so every so often she has a free Forex and Chill that people can come on and learn about, you know, trading and things of that nature. You can make a very, very credible living trading. You absolutely can. It is not a gimmick, but it is a skill that you must work at to get better at. All right. What she is teaching you in the first hour, for those people who've been on since the beginning, she's taught you how to do market structure, how to analyze the market. Once you become great at analyzing the market and understanding the what, the when, and the where, and all of that, what, where, and when, things of that nature, then you'll understand, okay, here's my stop loss. Then I am anticipating the market will not pass this point. That will tell you your stop loss. From there, it's about risk management. Once you understand how much money you're willing to risk, from there, it's just risk management. All right. Learning how to analyze the market and learning how to manage your risk. If you can conquer those, and I know you can, anybody can. It is not something that you have to be a genius at. You just have to work at it. Some people, it comes faster than others. You must be diligent. I tell people all the time, you need consistent discipline, and it takes discipline. You can't be greedy, all right? Because greedy people try to make more money in a short amount of time, and it always bites them in the end. It's going to bite you in the end. So I'm just grateful. I appreciate Gigi. I mean, it does help that she's one of my best friends, and she knows that she can call me at any time that she needs me. And I'm just grateful because, again, ForexNChill is a brand. It is a major brand. When you have people trying to steal your brand, that's when you know you've made it. and she can tell you that I'm telling you the truth. All right. People have tried to steal this idea from her. You hear ForexNChill everywhere. She was the absolute first. Okay. So I want you guys to know that there are people on here who's been, you guys are what I call expert to intermediate, things of that nature. And then there are some people who are on this call, you are newbies. Don't worry. I was a newbie at one point or another. Gigi was a newbie at one point or another. Everybody on this call was a newbie at some point and had to learn what a pivot was, had to learn what a pip was, had to learn what a trend was, had to understand what bullish and bearish was. These are things that we had to learn. But I guarantee you, if you really, really commit to it, you really, really can get great at it. All right. Kobe wasn't the dominant person that he was in a year. It took him several years. How many of you are willing to put several years into this, if that's what it takes? If it takes you 10 years to earn $1 million, was it worth it? And all you make now is $33,000 a year. If you make $30,000 a year times 10, that means that you have made $300,000. But if you make $1 million in that time, then was it worth it? Absolutely, it was worth it. All right. I am admonishing you guys, go for the long game. It's just like losing weight. I am a personal trainer, and people come to me all the time and be like, I want to lose 100 pounds in 2 months. When you do that, it is very unhealthy. I tell people, try to lose 100 pounds in 2 years or 3 years. If it takes you 3 years to lose 100 pounds, then the same amount of time that you lost it takes to gain it back. If you lose 100 pounds in 2 months, trust me, you can gain that same 100 pounds back in 2 months. You lose it in 3 years, it will take you 3 years to gain it back. Slow, methodical. You really want to understand this. Take your time. This is the long game, okay? Long game. 80-20, 80% eating. Jay Scott, it is 100% eating. 100%. It's not 80%. It's 100%, okay? So, but that's another chat for another time, all right? I want you guys to know that, again, I'm grateful. Gigi knows I love her, and I appreciate you guys for being on here. The 62 people that are still on here at this point, those are the people that tell me they want it. because it was 100 people at one point or another. You 62 tell me you're looking for something, and you know that there can be some. I've been on Zooms and the nugget comes at the very last minute. Gigi, am I lying? That nugget can come at the very, very end, and everybody would.
I know. We used to have these 3 and 4 hour Forex and chills, and when everybody would get off, that's when I would get to the good stuff. But I'm tired tonight.
Absolutely.
I want to leave y'all with one thought. Okay, this is the way I want you to look at your Forex trading career, because it is a career. Okay, it is 100% a career. People do this for a living. When you start getting paid to do something, that makes you a professional. So once you start making withdrawals from your Forex account, you are now a professional trader because you're getting paid to do it. But the thing that screws everybody up is they come into Forex and they focus on the money. Okay, that's all they think about is that money. They don't focus on the skill set. But take this same person. This person, he sees an education. Let's just say this is a school. That's a school of something or whatever. And when they walk into this school, they're walking into this school and they're focusing on getting the education and the degree, okay? Because they know before they can make this money, that they have to walk into this school and acquire this education. This comes after this. What screws up Forex traders is they want this without focusing on this. So if you wanted to be a doctor or a lawyer or a police officer or a nurse or a cosmetologist or a plumber or a welder, before you get to this, you have to go through this. You have to walk through the doors of that education and learn. And then once you start applying that knowledge, that's when this comes. All of these people in these professional careers, they don't get the paycheck until they put in the education. And it's going to be the same thing with Forex. If you come in here and you focus on falling in love with the charts, falling in love with the risk management and the trade management, the next thing you know, this is going to appear. You're not going to have any school loans. You're not going to have a boss. You're going to have financial freedom. You're going to have time freedom. So focus on the education right here. Focus on the school, the education. Focus on the charts. If you keep your eyes right here, this is going to come out of nowhere, okay? Focusing on this makes you desperate. It makes you gamble. It makes you take risk. And it messes up your psyche that you will never become that profitable trader that you should be. So I want you to come over here. Let's see. Let me do this right here. All right, that's me. When I first joined, all I knew is that I was working in Afghanistan, making 6 figures a year, and I wanted to replace it. And I was focused on the money. When I became focused on the education, that's when the money came. So that's all I want to say to you guys. And we thank you so much for joining. I didn't anticipate us going over 2 hours tonight, but we did. I will post the recording. There's the link to join the Telegram. I'll post the recording there probably sometime tomorrow. So for those of you who missed it, that you will have it to rewatch as much as possible. But focus on the skill set and the money will come. Don't trade out of desperation because you're going to gamble. When you start risking money you don't have, you're now a gambler. Okay? Whatever job is paying your bills now, let it continue paying your bills until you can stand on your own 2 feet with trading. And that's it. God bless you guys. Thank you so much, Money Coach and Grant. Thank you, family, for jumping on. Y'all have a great rest of your weekend and a happy holidays. And we'll do this again pretty soon. I'll upgrade, that way nobody will get turned away.
Thanks,
right, thank you so much, guys.
Thank you, guys.
Thank you.
Thank you, Gigi. Thank you.
Thank you. It's nice hanging out with you guys again. Look, I'm gonna drop the link
Gigi
again.
and Coach Chris.
Somebody asking for the link. I'm gonna drop the link again. Y'all click that link. click the link.
Hey, can you drop your BE link? Thanks.
Yes, message me and Telegram and I'll send it to you. All right. Thank you.
Cool, thank you.